Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia. His website, victoradair.ca. Victor, even though you're not working for somebody else, you're still really, really busy.
Well, I've been trading commodity futures and options markets for almost 50 years, and I can't imagine quitting, Jimmy. So yeah, I'm still busy. There's so much going on in the markets that I trade. Give me access to let's say a way to trade all kinds of things that are happening in the markets. Yes.
Now we saw the Dow hit a new all-time high. It seems every week one of the major stock markets does. Even though we had a drop of about 5% during September, are things going to go higher now, and are you a buyer here?
I am not a buyer here, and we're talking here with the Dow, let's say more or less at all-time highs. We hit some highs in August. We had that dip, as you say, down through September. We've rallied back, as have the S&P, the NASDAQ not so much, Russell not so much. In the last month or so, I've traded the market on both sides. I've been a buyer and a seller for some of the short-term swings that we've had in the market. Today is Thursday. I have been patient for the last 3 days. I have done nothing after covering a long position at the end of last week, waiting for the market to kind of roll over here. And a lot of the way that I look at the market is just sort of psychological waves in the market. We'll have the market gets bullish and prices go up, and it gets tired of being bullish and has a rollover in different time frames. On a very short-term time frame, I think the market's got a little exuberant here, and I have been waiting for opportunities to be short. Now, here's a thought. If the market is rallying, and I think it's, say, goofy overvalued or any other kind of term like that, I don't just automatically sell. I wait for the market to actually roll over or give me signs that it's rolling over before I'll put a short position on. Now, in the background, we have seasonality, and that is, let's say you go back over the past 40 years and average out, most of the time what happens in the October to December period. And in the stock markets, outside of, a couple of big hits like we had in, say, 2008 or 1987, the stock market generally, the broad indices generally trend higher in October, November, and December. So, I'd be fighting that to be short, but, I don't mind fighting something like that if I see a short-term opportunity. So here at all-time highs, I am not a buyer, and I'm looking to find some short-term, short opportunities.
The Toronto Index also sold off during September, but has rallied to new all-time highs, about 5% higher since the October lows. Why the divergence with the American stock markets?
I think if you're going to put one word on it, it would be energy or commodities. That would be, your first guess. But I was intrigued by that. I have been looking. Let's put it in this framework. I look at correlations between markets probably more than I look at markets. In other words, if X is going up, what's Y doing, and why is it doing what it's doing? So I've noticed that the Toronto market has outperformed. Did a little looking at that, and it's not just energy and commodities, although that's big. I mean, the major Canadian bank shares are up about 10% in the last month. I mean, that is a big move. Now, maybe it's just a play on Canada. The Canadian dollar has also been rallying here the last, call it 3 weeks, 4 weeks. So it may be just that. But one of the overall psychological things that is going on in markets right now is this very bullish framework around energy. We've seen, for instance, natural gas prices in Europe have absolutely skyrocketed, like gone up 4 or 5 times what they were 6 weeks ago, with shortages, presumed shortages going into winter. Maybe they're not going to have enough natural gas to, turn the heat on. We've seen uranium prices, explode higher. Although maybe saying explode with uranium's not the right thing to do. The Toronto market, and another way I look at the Toronto market is it's kind of the high beta market, and that might be that near the end of a run in stock markets, you'd expect maybe the small cap markets or the resource markets to be outperforming the broader markets. So whatever. Let's just keep it simple and say, yeah, Canada's a play on energy, Canada's a play on commodities, and even the bank shares are up. So, and sometimes, by the way, and this is also important, it's not important to understand why something is happening. I, used to have this conversation with my son so many times when we were working together to say, we don't know anything compared to the things that are out there that you should know to understand why the markets are moving. And if we think the market is going up because of this reason, and it goes up, we're likely to think we're right, even though we could very well have been that the market went up for some other reason entirely. So, I was an analyst for years and years and years in the brokerage business, and the brokers and the public that would be looking at my research, always wanted to have an explanation as to why. And so, as an analyst, you felt you needed to meet that demand. But I just, as a trader, I'm more and more convinced that you need to be cautious about thinking that you've figured out why something is happening.
I guess it's the old, they used to believe the sun rose because roosters crowed in the morning.
Yeah, good. That's perfect. Let's leave it at that. The rising rooster. I like it.
Energy markets have been soaring lately. One explanation is that the ESG mandates mean that traditional energy producers are not spending enough money to build reserves. What are your thoughts?
Well, I absolutely agree with that. I see that the major Canadian pension funds, for instance, are divesting any of their holdings in fossil fuels. Let's make it broad. And, that's a trend that's going on all around the world. People like Shell or Exxon are being dictated that, they need to spend more money on, call it, developing renewable sources of energy, and must cut back on their spending for let's say replacing the reserves that are drained away as they put oil into the market. And that's going to be a problem. It's already a problem in the terms of the ESG mandates to switch from fossil fuel energy supplies to, call it, non-fossil fuels or renewables or whatever, alternative energy. I think is unrealistic in terms of how much it's going to cost, in terms of the timelines, and in terms of compliance. If you're unrealistic on those fronts, it doesn't matter where you're right. Other than as the young progressives in Washington might say, it doesn't matter whether or not I know the truth. It's just what I believe. That's certainly a part of it, and. Let me give you this real-world example. Right now, we have severe backwardation in a number of energy markets, and what I mean by that is there's two prices. Okay, there's a price for something if you want it today, but if you're willing to take delivery of it 6 months from now, well, that's cheaper. Okay, and that's just how it is. We have what we call time spreads. That's the price of, let's say, the spot market relative to the more deferred markets is very steep. And that just shows that there is an imbalance between demand and supply for right now. And that is usually something that happens in bull markets. You get a bear market, it's the inverse. If somebody is offering you something for delivery right now, it's cheaper than if you want it 6 months from now, and that's what we call a contango market. So these time spreads, I think, are a real good measure as to the tightness of a market, and clearly the markets are tight. So we got these shortage risks. I mean, they're making the news, and as I said earlier, there's the psychological thing that's like across markets right now, that we're desperately short of energy and we're going to really have problems. And of course, in that environment, we have people that are forecasting much, much higher prices. Now, I'm not saying this is going to happen, but I do remember very clearly as we went through the spring of 2008 into the summer, and WTI prices in July of 2008 hit $147 a barrel after a very steep climb since the beginning of the year. There was a very a famous chief strategist at one of the major Canadian banks who was pounding the table that we were going to $200, $300 a barrel in the very near future because of X, Y, and Z. The fact is that 5 months later, oil prices were $34 a barrel. And this kind of goes to that thing I was saying a moment ago about why. You know, you think you've got it all figured out and it's a lead pipe cinch and you're dead wrong. Or you could be dead wrong. Now, I'm not saying that we're going to see oil prices drop from $83 here down to substantially lower, in a heartbeat. But, when the market is so one-sided and everybody and his dog is screaming that prices are going higher, that's a market where, I don't want to be a buyer. Doesn't mean I'm going to be a short seller, but I just get cautious when the crowd gets that aggressive.
Is Bitcoin the go-to inflation hedge for millennials like gold was the go-to hedge for the boomer generation?
Well, isn't that a dandy question? Looks like it. There certainly are folks that would argue that, it's the old fuddy-duddies that are, like yesterday's man that are, bullish on gold, and the new thing is all of the crypto coins, whether, and I don't know how many hundreds or thousands of them there are. Certainly Bitcoin is the poster child, with just the ETF being released here, and I guess we're trading it at new all-time highs. But speaking of that, again, if you don't learn from history, you're destined to be squashed by it when we go forward. I was there trading gold, working for a large American commodity brokerage firm back in the 70s and into the early 80s. And I remember gold going from $450 an ounce to $850 an ounce and back to $450 an ounce in 4 months. I remember the people lined up around the corner to get into the Bank of Nova Scotia to buy bars of gold. And I thought, wow, that's certainly a sign of a top, when gold was $450 on its way to $850. So, you never really know where you are in the cycles of some of these markets. But I'm not answering your question. Is Bitcoin the new go-to inflation hedge? I can't imagine that it is, given the volatility of the price. It's had some amazing surges to the upside and then take a 50% crack to the downside, like I just mentioned with gold here, and then back up to new highs and so on.
All in one day.
Yeah, perfect. Yeah. So that doesn't sound like the sort of hedge that you'd like to be involved in. But Jimmy, if I could just kind of digress a bit here for a moment, it reminds me something that I've been thinking about lately is that, markets keep changing. You might say they evolve, or maybe it's more rapid than that. But, I have to be very cautious in terms of reminding myself that some of the, call it old school metrics that I have been used to using for years and years and years might be dangerously out of date. It's a brave new world, Bucky, and if you're not aware of that, you're going to get not only left behind, you're going to get chewed up to dust. So I don't know. I think certainly millennials are more likely to buy or to trade or to hold Bitcoin or call it cryptocurrencies than they are likely to buy gold. That's certainly the case. There are more millennials now than there are boomers. Boomers are dying out. So, maybe they're the dominant force in the market and that's how it'll be. But, if you had a bar of gold, I'd hang on to it. I wouldn't just throw it away because it's not going to be good anymore.
Well, it wasn't that long ago people were describing gold as nothing more than pretty rocks.
Sure. Yeah. Well, there's always people that want to make fun of something, and they say stuff like that. I was trafficking in gold 50 years ago. Actual physical bars of gold and silver, and I've put a lot of money into mining companies over the world. I've certainly traded thousands of contracts of gold on the futures markets and so on. It's something to trade for me. It is unique in a lot of ways in that, all the gold that's ever been dug up out of the ground is pretty much accounted for. We haven't lost a lot of it. We haven't burned a lot of it or anything like that. It's still around. And, it has a 5,000-year history of being money in one form or another. So, you'd ignore that at your peril.
In our previous interviews this year, you've generally been bullish on the U.S. dollar. Have you changed your mind about the greenback?
Yeah, I have been generally bullish, and in terms of changing my mind, that would, I'd have to put a time frame on that. Certainly, the U.S. dollar the past couple of weeks has been soft, or it's come off. It's the highs that it made. I think we got to, I'm guessing here, sorry, but certainly the highest we've seen in a year or more, early this summer. Yeah, I think here's the way I see the U.S. dollar. The U.S. dollar gets bid when people are worried. Okay, so if the stock market is soft, like let's say over the past month or so, when the stock market was going down, the U.S. dollar was going up. When the U.S. dollar was going up, gold was going down, at least gold in U.S. dollar terms. And lately here with the stock market rising, by lately I mean the last 3 weeks or so, the U.S. dollar has been soft. So, in a way, they are two sides of the same trade. And right at the top of our interview here, I mentioned that I look at a lot of markets, but I also look at a lot of correlations. If the U.S. dollar is doing this, what's something else doing that? For instance, the Japanese yen has been amazingly weak here the past little while, and not only weak against the U.S. dollar, but extra weak against the Canadian dollar, because Canadian dollar has been going up against the U.S. dollar. And it could be, in a way, just as simple as saying Japan is very reliant on imported energy. Okay, whereas Canada is a net energy exporter, and when there's a bull market in energy, then maybe the yen should be soft relative to the Canadian dollar. And we've seen the euro struggling, but the yen has been sort of the dog. Although, if we want to broaden the franchise a little bit, I've been amazed at how weak the Brazilian real has been. I mean, it tumbled like a lot of things did in the spring of last year when the COVID panic was hitting in, call it March of 2020. But it really hasn't done anything since then. It's just kind of chopped sideways, despite, an amazing bull market in commodities. And Brazil is a producer of commodities. And they have not benefited. So maybe it's, the political situation there is perceived to be bad. I know the stock market in Brazil hasn't done anything like what stock markets in North America or Europe have done. So, to come back to your question, sorry, I wandered a bit. Am I still generally bullish the U.S. dollar? Yeah, I am. Not a raving bull, that it's going to the moon, but a lot of people, I think, that want to trash the U.S. dollar just see it relative to things. So the purchasing power of a U.S. dollar in terms of how much crude oil you could buy or how much real estate you could buy or how many units of the S&P 500 you could buy, U.S. dollar has been in a big bear market, right? Obviously. But relative to how many euro you could buy, or, South African rand or British pounds or Japanese yen, US dollar has been in a bull market. So I really need to make that distinction. When I'm talking about being bullish to the US dollar, it's relative to other currencies. And if you think the US has got problems, in a really organic way, other countries have maybe worse problems. So yes, I remain generally bullish US dollar.
Yes, I've heard the U.S. dollar described as the prettiest horse in the slaughterhouse or glue factory.
Yeah. Well, okay. I don't know if you can say that this is not live radio anymore, but yes, something like that.
The Canadian dollar hit a 6-year high at 83 cents in June, fell back to 78 cents in August, September, now bounced back to 81. Where do we go from here?
Yeah, the Canada is, I think, a derivative of the other markets. In other words, Canada's not charting its own course. It's taking its lead from, and if your listeners will forgive me, I probably make this point every time we talk, but the things that drive the Canadian dollar are how strong or weak the U.S. dollar is relative to currencies generally, what the commodity markets are looking like, and certainly lately what the stock market's looking like. So if commodities are bullish and the stock market is bullish and the U.S. dollar is soft, then I'm going to tell you, it doesn't matter anything else, the Canadian dollar is going to be going up. And like the Canada, just talking about Canada versus yen, the Canadian dollar here is at a 6-year high against the Japanese yen. Now, if we go into an environment where the bullishness goes out of the commodity market generally, and energy specifically, if the bullishness goes out of the stock market generally, and the U.S. dollar gets bid, I'm going to tell you, the Canadian dollar is going to be going down. Nobody in the world of commodity trading, I just about swore, cares about, what young Trudeau is doing down in Ottawa. Believe me, it just doesn't matter in terms of the world of FX unless he really was doing something outrageous or more outrageous. No, it's these other things. So Canada is like a cork in the ocean, and it's going to go where the ocean takes it, and the ocean is going to be the U.S. dollar, the commodity markets, and the stock market.
Interest rates hit historic lows last year, but are rising lately, apparently in fears that inflation is coming back. Should we be preparing for more inflation, or are the recent numbers transitory, in quotation marks, as the central banks keep claiming?
Well, yeah, it's pretty hard to cling to that story anymore, and I guess the market is sussing that out. We've been seeing the past couple of months here, the interest rates are working higher in the United States. I've been kind of ambivalent. Because trying to make economic forecasts doesn't really do much in terms of helping me trade more profitably. So, it's kind of like a coffee table or conversation. But at the same time, it's important to kind of be in sync with the direction of macro policies. So my thought was, I will know, or I will believe that inflation is not transitory, because we have all these supply chain shortages, and also we've got the look back to a year ago when everything was in the tank because of the COVID lockdowns and so on. I will know it's not transitory when we see wages rising and when we see rents going up. Those are two hugely important parts of the calculation as to what is inflation. And it looks like that's happening. Labor, we see the quit rate in the United States. In other words, the number of people that are just saying, see you later, Charlie, and walking out of wherever it is that they're working. Something like 3% of the workforce just in the month of August. And employers are the number of job openings are higher than ever, certainly relative to the number of people that are in the workforce. So labor's got some leverage here, and we haven't seen labor have leverage since certainly even before globalization started and your job got sent overseas. So now that labor's got some leverage, the employers, either actively or proactively, are having to pay more to get somebody to work. And, that feeds through to, people have more money to spend, so they'll bid up stuff. And then on the other side, of course, rents. With, real estate prices going up, it would seem to me it's pretty inevitable that, if you buy a house and you want to rent it out, because if the house costs more, you're going to need to charge more rent. Just that simple. So rents are going up. So I'm of the view that, transitory is canceled, that we have higher inflation. And, now that's inflation in a CPI sense. I mean, I'm certainly totally aware that we've had fabulous inflation in financial assets, like share prices and so on, and bonds, look at it that way. But yeah, I think inflation is here to stay. The thing will be what, happens because of that. We have some chop in the market, prices surge ahead and then adjust and maybe back up a little bit and then surge again. The market seem to be taking interest rates higher anyway. And if interest rates are going up, and let's get just a little technical here, but, stocks are a long duration, asset. And if the cost of long duration, long-term money, like bonds, goes up, then that puts pressure on the price of stocks. In other words, I'd say if we saw yields on the 10-year bond go to 2.5%, that would matter to the stock market and matter in terms of stock market would go down. So, and at some point when prices of commodities go up, the old saying on the floor was that the best cure for high prices is high prices. That higher prices do dampen demand and encourage supply. It's kind of like you'd be amazed at how much stuff people can find and deliver to the market if you're paying a hell of a lot of money for stuff. So, I think inflation is here rather than being transitory. Then we'll see what kind of impact that has on markets going forward.
Well, you talked about wage demands and so on. Friend of the show, Mike Swanson, pointed out the other day, strikes in the U.S. are at their third highest level ever. People need higher salaries. It's not just a case of I want. It's more of a case of I need.
Yeah, that's what I mean by labor has leverage for the first time in 30 years. Jimmy, you and I are back in the 70s. We remember every time you turn around, somebody was on strike, for something. And we don't even, I think maybe millennials don't even know what the word strike means. I mean, it just hasn't been the experience. We had 10,000 people walk out of John Deere, tractor, manufacturing plants last week, demanding higher wages. And then there's the added confusion of, if you're not vaccinated, you're fired. Well, I mean, that's just wild in terms of what that's going to do to, wages for people that are still on the job and so on. So, yeah.
Back in 1982 at CKNW Radio, we used to get, every quarter a cost of living bonus. For me, because I was one of the lowest paid guys, it maybe be $130. Some people were making $1,300 extra every 3 months because of inflation.
Well, we are seeing in the United States, and I expect it'll happen in Canada as well, that the seniors who get their old age pension check, and that would include me these days, are going to get a bump up in the amount of money because of the CPI calculations that go into figuring out how much the government wants to make the check for.
And of course, we know official inflation isn't the real rate of inflation because they exclude things like energy, housing, and taxes.
Yeah, there you go.
We'll have more with Victor Adair right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Looking at your weekly blog on victoradair.ca, I see you've been writing a lot about China. You've covered several topics, but is there just one big issue that's really got your attention there?
Yeah, Jimmy, I think China is, it's hugely important. And there's been so much going on. I mean, we've had the Evergrande, $300 billion in debt, and looks like they're unable to pay. The size of their residential real estate market makes it the largest asset class in the world, and of course, it's built on debt. We remember it was fall about a year ago that the leadership in China took the boots to Jack Ma, and basically took him out behind the barn and straightened him out. And that I guess was just a taste of what's been coming. The terminology is common prosperity. Xi Jinping is, it appears to me, and clearly I'm not the China expert, but if you're going to be a trader, you can't ignore these things. You want to try to get some understanding. He's trying to reshape China. I think in my cynical way, I would see it as he's experienced the largest human migration in history. Hundreds of millions of people have gone from the farm to the city, to get higher paying jobs. And those folks are going to be unhappy if life gets much harder for them, or if it's in their face every day that there's massive inequality in the system, where some people are getting filthy rich. There's more billionaires in China than there is in the United States, while huge hundreds of millions of people are still scraping by. So I think there's this reshaping China where they're going to essentially the essence of socialism. They're going to take away from the rich and redistribute, to the poor, as though that is the fundamental job of government, is to redistribute wealth in a socialist view of things. But it's about control in terms of, if all those folks, the poorer people feel as though they're being disenfranchised or whatever, or they can't get ahead or they can't get a job, they may bring down the house. So I think here's where I'm going with that, is that China just might be way more fragile than what we've assumed. I mean, China's been the largest taker of commodities for 25 years. They've reshaped the world in terms of, jobs that make stuff there, and, their exports to the rest of the world mean that, you can make something in China now and send it to the United States for much less money, so people were doing that. But if China is more fragile than we had expected, is not nearly as robust as we thought. In other words, I think that the thinking was that, well, the debt is internal, most of it, to China, and the Communist Party's got a lock on control of the country, in parentheses, picture, Sudet East Germany. Look how that worked out. But what if there is a dramatic change in China in terms of, maybe they just kind of turn inward instead of being, facing to the rest of the world and taking things in and shipping things out. So I think one last way of examining it, I remember in the late 1980s, Japan was going to take over the world. I was in, the airport at O'Hare in Chicago after being down visiting the floors, and I was coming back to my home office, and I went into the bookstore to get a book to read on the flight home. And the business section, like everything, was about how Japan was the biggest, the best, and they were going to take over the world. You couldn't buy anything else in the business section of the bookstore than that. And then we've had Japan just kind of go in the doghouse for 40 some years. What if China is not going to take over the world and not going to become in a heartbeat going to become the world's largest economy and all that sort of thing. So I guess from a trading point of view, it goes to my basic thought is, you have to keep looking at your assumptions and just assume that what you assume is probably wrong and it's going to change. And one of my favorite signs that I used to have scotch taped to my trading screens for years was anything can happen. And and one thing you can be sure of is that things will change.
Well, the Chinese government, I'm sure, is very well aware that they were created out of a people's revolution because they were tired of starving to death and being ordered around by very rich people.
Yep. Yeah. Anyway, as I say, we kind of, and maybe because there's so many moving parts in the world, we just kind of want to peg a few things and say, okay, let's just keep that steady, and we'll deal with this other thing over here. It's like the old cartoon of the guy with 12 different plates on a stick, and they're all whirling around. He's running around to kind of keep them from crashing. I just think that, the world keeps changing, and some of the assumptions that we make that something is going to carry on the way it is, we need to be careful about that as traders.
Yes, centrally planned economies have an advantage that you can do long-term planning, but they're horribly inept at dealing with short-term change or dealing with sudden adversity because that wasn't in their plans.
My uncle is one of the world's foremost authorities on the Russian settlements on the west coast of the United States in the call it the 1810 to 1850, and he has just written a book that's going to be published soon that details the massive famines that they had throughout the USSR, not just Russia, not just Ukraine. And the famines were entirely due, in his point of view, to government mismanagement, and they were unable to get food to people, and millions of people starved to death in the 1930s under the Stalin communist government. And my uncle is, God bless him, has been a socialist all his life, and yet he's really pointing out that here's an example of where a centrally planned economy went horribly off the rails because, and this would be me talking, if you leave it to the people to decide what to do, you'll solve problems better than having somebody at headquarters just issuing orders.
Before we wrap up this interview, can you tell us how you trade based on the ideas you've just discussed? Okay. I trade futures and options on futures, exchange-traded futures markets, the big ones in the United States. I don't trade futures markets all over the world. I have a relatively short-term time horizon. That would be a few days to a few weeks is where I take positions. 40 years ago, when I was trading as a commodity broker, I would be working every cent of capital I had in my account to margin positions. These days, I'm virtually the opposite. I trade with practically no leverage. There's enough volatility in the markets that I don't need to use leverage to gain an advantage. I'm a trader, not a visionary. I don't say, for instance, and I had some wonderful conversations with Doug Casey, and I love to watch Doug Casey work a room. I mean, he was very, very good at it, and he'd say stuff like, gold is going to the moon, and everybody would roar with in agreement and happiness. So I don't know where something's going to be 20 years from now. I try to, I guess I form some opinions about where a market is and where I think it might go. And then I look for what I call setups. So if a market has been rising and I think it's probably has risen too far, I don't sell it. I wait for the development of some kind of a topping pattern, whatever the hell that is, and I'll have different thoughts on that. And I'll put on a position. I'll put on a small position, and I'm very prepared that I'm going to take a small loss if I'm wrong in the trade. I lose money on more of my trades than I make money on, but my losses certainly are, if you average them all out, they're much smaller than the profits that I have. I talked earlier about, I look at a lot of markets, but I really look at correlations. In other words, let's say the example of the Canadian dollar. If I'm trading the Canadian dollar, I absolutely need to be aware of what's going on in the commodity market, the stock market, and the U.S. dollar market. So I would, for instance, if I was
let's say I'm already long crude oil and I decide independently that the Canadian dollar looks like a buy. If I buy the Canadian dollar, then I am sort of doubling my market exposure to the same trade, in effect, that if crude oil turns and falls, the Canadian dollar is likely to turn and fall as well. So I'm in terms of managing risk, I really pay attention to correlation. And I would say, when I was an analyst or when I'd be speaking at conferences, people want to know what to buy. Tell me what to buy, what to buy. And I'm going to say that managing a trade once you have it on is way more important than picking the trade in the first place. Because, at that point in time when you put the trade on, you made your decisions about this, that, and the other thing, and you decided to buy something or sell something. But then, now you got it on, now things start to change. Some of those things that you thought you saw before aren't there, or you believe this or that, and that's changed. So now what are you going to do? Whether the market's going up, going for you, should you be, say, moving a stop behind the trade? Should you be buying more if you're along that? If it's going against you, should you be getting out? And if you don't know, before you put a trade on, where you're going to get out of it, or for what reason you're going to get out of it if you're wrong, then I'd say you should change your attitudes. And one last thing, I guess, is that for me, no single trade is important. But it is just a trade. It's not my ego tied up in this. This is not a life and death situation. It's not please God, let this trade work for me because I really need the money. It's just no single trade is important. It's just another trade in the process of making hundreds or thousands of trades. So don't let any trade be important. And the worst thing you could do would be to let any one trade turn into a big loss. Just absolutely, for me anyway, that's important. I shouldn't say never because, by gosh, you never know what's going to happen. But, I try to organize my affairs here with my trading and manage my trades so that I am not going to take a big loss on any trade.
Victor, thank you so much for chatting with us.
Jim, it's always fun. It's maybe a little cathartic for me to do this with you. I appreciate the opportunity. Thank you kindly.
My guest has been Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but he still loves to dish out the advice, and he's still an active trader. Check out his website, victoradair.ca. If you have any questions for our guests, including Victor, you can send them to info@howstreet.com, and we'll ask that question for you. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.